Good afternoon. I'm Patrick Armstrong, Chief Investment Officer at Plurimi Wealth, and I'm here today to talk about the Fed and the looming policy mistake that inevitably they're going to have to make. They're going to have to make a decision that's going to impact pretty much every asset class and probably change the way we all view the world as investors. And um, what's priced in right now is on May 4th, the Fed is going to be hiking 50 basis points. There's a small chance they're going to be hiking 75 basis points, but almost certainly it's going to be at least 50. Jerome Powell's indicated a 50 basis point hike is expected. And it's not only expected at the next meeting, it's expected at the next three meetings 50, followed by another 50, followed by another 50, which sounds scary and is scary in some respects. But that'll put the Fed funds interest rate at about 2%, which is below even their target inflation and definitely below anticipated inflation. So even though the Fed will be hiking quite aggressively, their policy will still be accommodative and still be stoking inflationary pressures rather than curtailing inflationary pressures. So it will be scary moments for markets because we're not used to a Fed hiking. Last time they hiked was 2018. And historically, whenever they have hiked, a recession has followed shortly afterwards. So this chart goes back to 1971 when I was born. And you can see whenever the white line goes up, a red bar follows. And the red bars are where there's recessions. The white line is Fed funds rate. And what you'll see, which is not by coincidence, is the white line is almost always above the blue line, which is inflation. Typically, you want the Fed funds rate a little bit higher than inflation. Basically, if you don't do anything with your cash, you preserve your purchasing power in that environment. Where we are today, you've got a Fed funds rate close to zero, inflation at close to 8%, and investors are being punished by keeping cash on the sidelines. So this will slowly change. I expect inflation will come down, the Fed's funds rate definitely going up. But what they're going to have to decide between is provoking a recession, like they've always done in all past Fed hiking cycles, or letting inflation run hot. And no one knows for sure where it's going to go. But my expectations are the latter, that the Fed will hike. They'll hike 150 basis points. They'll see the market's reaction, see the economic impact or early signs of the economic impact. And if there are negative consequences to the hikes, which inevitably there will be some, I think the Fed would much rather have inflation above their target than provoking a recession, provoking a bear market in equities. So no one can be certain on the Fed. I think Jerome Powell himself doesn't know what's going to happen. He's going to be data dependent to some extent. And after experimental policies that the Fed's put in place, withdrawing them is going to be a tricky scenario. It's naive to expect the Fed is going to get rid of this inflationary pressures that I think are probably going to last decades um, by hiking rates and allowing a soft landing of the economy. So it's going to be a policy mistake. They've already made a policy mistake being so far behind the curve. And I think that's going to be a big decider of the direction of markets. Basically, if the Fed does as I expect, a range of hikes, but still staying accommodative, that sets a tailwind for risk assets. If the Fed does provoke a recession, I'll have to change my views. But I don't have a conviction that the Fed will follow through and really provoke the recession that would be required to really manage the inflationary pressures that are in the economy today. So, with that as a backdrop, I'm aware the Fed's going to be hiking. I think interest rates keep moving higher because inflation is going to remain persistent. I don't want to own treasuries, don't want to own government bonds. Credit's now reasonable to me. On investment grade bonds, you're getting a 4% yield on triple B US right now. That's higher than my inflation expectations over the next 7 years. So that all of a sudden makes sense after a 15% sell off year to date. In equities, I want to own equities with pricing power. I want to own dominant companies with big market share that basically aren't price takers in an inflationary environment. I think commodity exposure continue to make sense. So commodity stocks have been very weak the last 3 days. I think now is a great time to be buying them going into what will be a Fed hiking cycle based on higher prices.